Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner with a mid-month, in-between monthly market updates. A quick note to address market volatility. We understand that these markets are concerning, and we want to encourage you to reach out to us. The best part of our day is time spent serving you, and we sincerely appreciate the trust and confidence that you have placed in us. So let's address market volatility in just a few minutes. Before I do that, I want to encourage any of you that have not already registered for our upcoming event on October 26th to do so. You should have received an email. If not, feel free to contact our office. We will be addressing these and other items then. So we're clearly in volatile markets as of Friday's close. The S&P is down approximately 24%. This will give you some ideas just kind of where we are kind of post-pandemic. You see that we were at a pandemic low of 2237. We sit in the 3700 range at present. So we're still above kind of the high point pre-pandemic, but we've obviously traded off quite a bit this year for a variety of issues. We'll touch on each of them briefly. Another kind of unique characteristic of this year is how kind of everything's losing. 104 of 112 asset classes as of the end of October were down. So you just have a lot of correlation across asset classes, even including things like equities and bonds that are typically non-correlated. So it's easy to find ourselves in this cycle of market emotions where, you know, at the top of markets where you have the most risk, you're also the most happy. At the bottom of markets is where there's the most forward opportunity, but you're despondent or depressed before that gives way to hope, relief, and optimism. The problem with many investors, and this is very tempting in these very volatile markets, is that you tend to buy here and sell here. And that's where this data comes from. If we look at the markets, the 20 years ending 2021, you see all of these asset classes, and yet the average investor is only up just a little bit above inflation. And again, part of what drives that is simply buying and selling at the wrong time, buying in times of euphoria and selling when markets are down. We're going to be covering an election cycle here in the next few weeks. So as it relates to midterms going back to 1926, you'll see all years, the average stock market performance is 5.5, but in election years, it's a little bit higher than that for the first versus the last 6 months. And in midterms, that's even more pronounced in terms of the front half versus the back half of the year, with the exception of September, which happens to be the month that we're in. Now, these are simply guides as to what's happened over the last roughly 100 years in midterm election cycles, that there tends to be a last quarter that's positive. Again, that may not outweigh everything we're going through now, but that's just typical of midterm elections in terms of markets. So we're clearly in an economic slowdown. Q1, negative 1.6, Q2, preliminary read of negative 0.9. We're going to get a final read of that this week, so we'll see how closely it hugs that. We're clearly in a slowing economy, and the probability for an even deeper recession is increasing. The consumer is driving more than 2/3 of this economy, and we've started to see some weakness in the consumer in terms of credit card balance increase, quarter over quarter, and even being late or delayed in utility payments. We saw during the pandemic kind of a hoarding of cash. The average consumer, we've started to see that decline as well. So inflation is clearly front and center. The Fed most recently raised, again, another 75 basis points, kind of fulfilling what he said here in Jackson Hole, which is the willingness to provide or to bring pain to the broader economy in order to tame inflation, that as of the most recent read is running still at about a 40-year high. So we're in a period of time where you're combining slower growth and or recession with high prices, which is a kind of a stagflation environment. Now, during recessions, as it relates to stock market performance, you see these are the average stock market performance 3 months before, during, and then 1 and 3 years after. So a lot of what happens in financial markets is already priced into the markets by the time we get to a recession, and 1 and 3 years after, much better performance numbers. Also, bull and bear markets, a bear market we're in now, which is typically defined as a 20% decline from a prior high. Past bull and bear markets going back to 1926, the average bull market lasts 51 months, and the upside average is 162 versus the average bear market is 20, and the average bear market return is down 41. Part of what's happening in this environment is kind of an acute awareness of how volatile markets can be in the very short run, which is what this shows going back to 1950 is the 1 year spread in stocks from -40 to an almost +50. And what this indicates is that stocks are a very, very bad place for short-term money because of this wideness. By the time you move out 5 and 10 and 20, what you see happen with stocks is that that bottom side comes in. For example, 20 years, you're talking about, the bottom side is 6 versus the top at 17. So the point as it relates to your overall wealth management strategy is making sure that we're hiring the right assets to do the right things over the right periods of time. And again, a key wrong place to put assets is stocks if you need them for the very short run. And this just takes even a wider view, even though we're in a very bad market this year. This just looks at the 96 years going back to 1926, ending in 2021 in terms of how many of those 96 were positive, 71, and how many were negative at 25. And the average positive return was 21. The average negative is -13. Again, none of these negatives are fun to go through. We never know when markets turn, so we don't believe that we can time the market. However, we are rebalancing. We rebalanced just this past month. We're continuing to own themes like more US than anywhere else in the world, a cash overweight. We've started to reduce our value overweight somewhat, but we still have a lot of value-oriented positions. So we are changing things quarter over quarter, but we're not making dramatic moves to try to time the market. If you recall back in March of 2020, when all news was bad is when the markets turned. So that's what you tend to see. It's very tempting to try to time your way out of these markets, but you've got to get 2 trades right to do that, the trade to exit and the trade to re-enter. And that's very hard to do over a long period of time. We encourage you to contact us. Any questions, concerns, markets overall, we're here to serve you. And we know that these times are very difficult to go through. We don't know exactly where markets are day to day, month to month, and what's causing that. But hopefully this will give you some idea as to kind of what we see as what's impacting the markets and the responses that we're making. So with that in mind, we'll close. We try to keep this very brief. We will have another market update in October, kind of according to normal schedule. We wanted to send a special note out regarding recent market volatility. And again, I encourage you to contact us if you have any questions at all. Until we see you again, hopefully at the forum here in a few weeks, be well and take care.